At the Tokyo headquarters of Swiss bank UBS, in the middle of a deserted trading floor, Tom Hayes, a derivative trader, sat fascinated before a bank of 8 computer screens. It was 15 September 2008 and it looked in Hayes' mind like the end of the world. Good afternoon. Our topic for today is Libor interest rate manipulation, the most important number in finance. At his desk, Hayes watched the world processing the news of Lehman Brothers hurling towards bankruptcy. As each market opened, it became a sea of flashing red as investors frantically dumped their holdings. Hayes entered a panicking stage with all the information and started to calculate the best escape route. The chaos had let him buy cheaply from those desperate to get out and sell high to the unlucky few who still needed to trade. Not only did Hayes have to extract himself out of every deal he had done with Lehman, he also had to make sure in coming days interest rates would remain stable. As Hayes examined his trading book, one rate mattered more than any other: the London Interbank Exchange Rate, or Libor, a benchmark that influences $350 trillion of securities and loans around the world, and 2 years earlier he had discovered a way to rig it.
What is Libor? The London Interbank Offered Rate, or Libor, is a benchmark interest rate at which major global lend to one another in the international interbank market for short-term loans. In summary, it is the interest rate that indicates the borrowing cost between banks. How is Libor determined? Libor is based on a combination of 5 currencies, including the US dollar, euro, pounds, yen, and the Swiss franc, with 7 different maturities, leading to a total of 35 different Libor rates calculated and reported daily. Every morning before 11 a.m. London time, a panel of 16 major global banks are asked to submit an estimate of the cost of borrowings to Thomson Reuters, the organization that managed Libor rate setting process for the British Bankers Association. Thomson Reuters then calculate the Libor rate for each maturity and currency using the trim mean method, where the highest and lowest quartile are eliminated, and then averaging the remaining submissions. These results are published daily around 11:45 a.m. every day. Uses of Libor. Lenders including banks and other financial institutions use Libor as benchmark reference for determining interest rate for various debt instruments such as to price inter-affiliate intragroup loans, bilateral and syndicate loans, letters of credit, securitization, floating rate note, private placements in US and EU. Libor is used in many interest rate derivatives including forward swaps, options and cross-currency swaps to determine payment obligations for pricing purposes, including for the purpose of providing a quote.
During his time as a junior trader in London, Hayes had got to know several of the 16 individuals who were responsible for making the bank's daily submission for the Japanese yen. Brokers are the middlemen in world of finance. If a trader wants to buy or sell, he could theoretically ring all the banks to get a price, or he could go through a broker who is in touch with everyone and can find a counterparty in seconds. In the opaque over-the-counter derivatives market, where there is no centralized exchange, brokers are the epicenter of the information flow. The rate setters at the banks relied on them for information on where cash was trading. Hayes recognized their worth. He saw what no one else. By the time the market opened in London, Lehman's demise was official. Hayes instant messaged one of his trusted brokers to tell him what direction he wanted Libor to move. The broker sent his assurance, and over the next few hours followed a well-worn routine. Whenever one of the Libor setting banks called and asked his opinion on what the benchmark would do, the broker said, given the fatal news, that the rate was likely to fall. Libor may have featured in hundreds of trillions of loans and derivatives, but this was how it was said. Conversations among men who were depending on the day, indifferent, optimistic or frightened. When Hayes checked the official figures later that night, he saw to his relief that yen Libor had fallen. As the market convulsed, Hayes' profits and loss jumped around from minus $20 million to plus $8 million in just hours. But Hayes had another ace up his sleeve. ICAP, the world's biggest interdealer broker, sent out a Libor prediction email each day at around 7 a.m. to the individuals at the banks responsible for submitting Libor. Hayes messaged an insider at ICAP and instructed him to skew the predictions lower. He cranked his network to max, offering his brokers extra payments for their cooperation and calling in favors at banks around the world. Hayes was still in Tokyo office at 8 p.m. while the day's Libor were published. The yen rate had fallen 1 basis point while comparable money market rates in other currencies continued to soar. Hayes' crisis had been averted using his network of brokers. He had personally sought to tilt part of a planet's financial infrastructure.
Role of banks in the manipulation of Libor. Libor submissions are very predictable and the system didn't take much work to rig. Coordinating with contacts at banks, crooked traders could enter Libor numbers that affected the submissions used. That meant that over very short periods the Libor rate could be moved in one direction or another as desired. The financial institutions and the bankers were accused of manipulating Libor by benefiting themselves by making profits from derivatives that were pegged to the base rate during the financial crisis in 2007, which showed that the bank did well irrespective to the financial instability by falsifying the borrowing cost. According to the regulators, process of manipulating Libor were carried out by big financial institutions including Barclays, Deutsche Bank, RBS, JP Morgan Chase, Citigroup and the UBS. Barclays and 15 other global financial institutions came under investigation for colluding to manipulate the Libor rate beginning in 2003. Barclays reportedly first manipulated Libor during the global economic upswing of 2005 to 7 so that the traders could make profits on derivatives pegged to the base rate. During that period, swap traders often asked Barclays employees who submitted the rate to provide figures that would benefit the traders instead of submitting the rates that the bank actually paid to borrow money. Moreover, certain traders at Barclays coordinated with other banks to alter their rates as well. During this period, Libor was maneuvered both upward and downward based entirely on a trader's position. Following the onset of global financial crisis of 2007 to 8, Barclays manipulated Libor downward by telling Libor calculators that it could borrow money at relatively inexpensive rates to make the bank appear less risky and insulate itself. Artificially low rates submitted by the bank provided the bank a degree of stability on an unstable time. In 2012, as part of a settlement, Barclays admitted to misconduct in the manipulation of rates. Barclays was the first bank to take a penalty, coughing up £290 million in 2012 for manipulation. Several others have been hit with fines since. In early 2013, US and UK authorities fined RBS $612 million for rate rigging. JP Morgan Chase and Citigroup also became the first US institutions fined with comparatively smaller penalties. In April 2015, Germany's Deutsche Bank agreed to pay the largest single settlement in the Libor case, paying $3.5 billion to the US and European regulators and entering a guilty plea for its London-based branch. All told, global banks have paid over $9 billion in fine. The investigations were not just limited to banks and financial institutions, the traders were also penalized with manipulation of the Libor rate. Investigations into the Swiss bank UBS focused on the derivative trader Tom Hayes, who was the first person convicted for rigging Libor. Prosecutors argued that this allowed him to post profits in hundreds of millions for banks over his 3-year stint, after which he moved to US-based Citigroup. In 2016, a separate investigation by US authorities fined Citigroup $425 million after finding that senior managers at the bank knew about Libor rate trader Tom Hayes' illicit manipulation of the rate. At the same time, most of the fraudulent collusion occurred between Hayes and traders at RBS, which affected submissions across multiple institutions. Hayes was ultimately sentenced to prison for 14 years.
Future of Libor. Despite the scandal, Libor continues its role as a primary benchmark for global lending rates. However, the efforts of authorities to increase the oversight and accountability of the Libor system have spurred debate over whether reforms go far enough. After the allegations came to light, the government commissioned a major review of Libor and how it was set. One of the first impacts of Libor investigation was to raise questions over the role of central banks in failing to address the problems with the system. As a result, the UK government began considering reforms to Libor, whose regulation as London-based benchmark falls under the UK's purview. The UK Parliament passed legislation in 2012 to strengthen financial regulation in general and reforms the Libor system in particular. The 2012 law created the Financial Conduct Authority, a new government agency with centralized and expanded powers to investigate and regulate financial markets, including Libor. Subsequent changes to Libor were based on recommendations of UK government report led by UK financier Martin Wheatley, who became the first head of the FCA. In addition to the creation of the FCA, the oversight of Libor was passed from British Bankers Association to Intercontinental Exchange (ICE), where rates were now based on actual transactions for which records are kept and increasing penalties as well as criminal charges for manipulation of the rate.